there, welcome to Wealthy and Wise. Well, buying is exciting. Selling can be uncomfortable. But the best investors know the decision to buy and the decision to sell are really two sides of the same coin. This week on Wealthy and Wise, we explore the signals that value investors use to know when to stay patient, when to redeploy capital, and when a great investment thesis may no longer stack up. We were inspired by part of our conversation on last week's episode around CSL. So if you'd like to go back and watch that one, always worth your while. Also this hour, we'll examine what has triggered a Teaminvest sell for specific companies. I know you like it when we get specific. Plus, as usual, we'll answer one of your questions. First, though, let's add some value. I think it's fair to say that most investors spend far more time thinking about what to buy than when to sell, but disciplined investing requires both. So in this segment, we'll unpack the frameworks value investors use to make buy and sell decisions with Andrew Coleman from Teaminvest. And to kick it off, Associate Professor Mark Humphrey-Jenner will be joining us from the University of New South Wales. Welcome to you both. Mark, why do investors find selling so much harder than buying?
Well, firstly, thanks for having me. And there's really a few reasons, but a lot of it comes down to an extent, behavioral finance. And in particular, when people are looking at their winners and their losers, they have this loss aversion, this feeling they don't want to realize losses, even if those shares are doing really badly and are not going to recover. They're just hoping they will do so because they don't actually want to pull the trigger and actually see that loss occur in their balance sheet. By contrast, when a stock has gone up, to some extent, they can bank that gain and feel as if they've won something, even if they could have won more, but also then it becomes a realized gain, which feels psychologically better than a realized loss. A lot of it comes down to behavioral finance.
Yeah, so is it that humans are sort of naturally wired to hold on to winning investments for too long?
Well, naturally wired, we shouldn't be naturally wired for it, but it seems like that's behaviorally how it factors into what people are doing. And there's a lot of academic literature that shows exactly this type of thing. So it's the type of thing you should at least try to train yourself away from doing. And one way of doing this is to potentially, at least psychologically, mark to market your portfolio, whichever interval, monthly, weekly, whichever one you evaluate it, to effectively, in your own mind, reevaluate what your portfolio is actually worth. So kind of almost banked the wins, banked the losses, and you evaluate it prospectively rather than just looking back at how things are doing.
Yeah. So what, in your view, Mark, first, are the biases that most commonly affect sell decisions?
Well, there's actually quite a lot of biases that affect this, which is unfortunate, but recognizing them helps you avoid them. So the first one, of course, is this bias whereby people don't want to realize that loss, like I already talked about. Furthermore, there's a salience bias, whereby people will just recognize recent information at the exclusion of long-term historical trends. So, for example, there might be a recent shock that triggers potentially a decision that isn't really optimal because it might just be short-term volatility. Furthermore, and contrasting against this, and one really needs to balance these biases so they sound contradictory, but there's also a bias whereby people tend to under-evaluate long-term or potentially more difficult to evaluate potential gains into the future. And those as well tend to somewhat contradict each other, but it does mean they're two different biases people need to disentangle. And effectively means people need to prospectively analyze things analytically as time goes on, rather than just relying on what's happened at a unique, specific point in time. That is, they need to think about what's going to happen going forward. And effectively, the problem is people often look too historically, look at what has happened in the past, and potentially look at their losses as a degree of wanting to avoid realizing those rather than actually looking what's going to go on in the future.
All right. Andrew Coleman, Teaminvest, do those sort of behavioral biases jive with what you experience oftentimes when you're speaking with people out in markets?
Yeah, I mean, we've done a lot of work on this, obviously, for our own selves, but and our members, as well as just in general research terms. And there's really, as Mark was talking about, there's a bunch of them that interact, but the sort of 5 key ones are the endowment effect, what I jokingly call get-even-itis. That idea that once you own the stock, you love it and you need to get even on that stock, and everything you own about it is good and everything about something else is bad. FOMO, that idea while the stock price is rising, that even though you now know it's probably not going to keep rising from here in the long term, you feel a need to exit at that price, or also not to exit at that price and to ride it up higher, a fear of missing out. The sunk cost fallacy, that idea of the money that's in there is really what's relevant, and you got to hold on until you can get it back, rather than looking at the opportunity cost of what you can do with the money. And then the recency bias and confirmation bias stuff that Mark's pointed out. But really what they all end up leading to, and what an investor has to be really careful about, is what you don't want to be doing is cutting the flowers and watering the weeds. In other words, selling out of the best companies just because the price has risen and you can lock that gain in, and holding on to the worst businesses in the hope that they will come back. You want to do the opposite. You want to water your flowers and cut the weeds, not cut the flowers and water the weeds.
Yes, but Andrew, is there an argument as well, if a stock has done extremely well, extraordinarily well, valuation metrics are riding high, to trim your position, even if you think it is still a good business, but when you just are recognizing that valuation has just gone out of whack?
I think they're two different questions. I think if the valuation's gone out of whack, you're better off exiting. And we'll talk about that a bit later, because that now is a FOMO problem, right? You're sitting there with an endowment effect telling you that, you want to keep holding on for that higher price rise, even when that price rise is not justified by any of the fundamentals. So from that point of view, that's a complete exit. I would separate that from this mistake that investors often make of, when there's a little bit of a gain, taking some off the table. We use that language a lot on shows like this, and it's a very dangerous language, because, of course, if the business is a good business and it still justifies its valuation, the market hasn't got toppy, it's reasonably valued, then there's an opportunity cost of exiting. You've got to find something just as good to put your money in. Otherwise, you would have been better off staying where you were. So I think it's important to separate those two, and we'll talk about them in some examples. But, a company that has risen, say, 40%, off the basis of earnings rising 40%, that's not a take your money off the table scenario. That's just good fundamental analysis. On the other hand, a company whose share price has doubled while the earnings have shrunk, that's a get out of jail free card, and you should be taking it.
Yeah. All right. Mark, back to you. Can strong past performance, make investors more vulnerable to future disappointment?
Yeah, absolutely. So as we've just talked about, that strong past performance can encourage people to hold on to a stock for too long, potentially anticipating it's going to continue forward into the future. So we see this all the time, particularly with people who really start to become wedded to a stock. So we see this, Tesla had this for one point in time, whereby people would just hold on to it, believing it would keep going up. And it has done quite well, but not over all time periods, meaning that people would just anticipate it continuing to go because it had in the past. And that past performance is not always an indicator of good future performance. Rather, future performance derives from how the company is actually doing at that point in time.
So the disappointment I think that many investors often feel, though, when market darlings experience such dramatic reversals. So what you're saying is this could be why we see such dramatic reversals once sentiment changes.
Some of it comes down to that. So once sentiment changes, you do get a retail investor effect where people just head for the exits. But also to some extent, when markets change, you do at least see reportedly and anecdotally that sometimes people trim their losses to try to make up for trim the stocks that have done quite well to make up for the losses on the ones that haven't, particularly if they need to cover short positions. So you do see a little bit of rebalancing there. And oftentimes it is easier for them to psychologically accept that they've made some money and they take some off the table than it is to psychologically accept that they've actually lost money and their position was never good to begin with. It really is a more humbling experience to realize that the decision you made in the past didn't actually turn out for the best and actually having to catalyze that loss.
Well, fascinating stuff. Mark Humphrey-Jenner joining us from the University of New South Wales again. Thank you so much for your insights.
Thanks so much for having me.
Take care. All right. So back to you now, Andrew. If emotion is the problem, does the answer, I would assume, become, that you need a really disciplined framework from buying and selling?
Yeah, there's a huge amount of evidence, and particularly Daniel Kahneman's book Noise, if anyone wants to dig into it, goes into this in a lot of detail, about the fact that basic checklists tend to beat decision-making or judgment in almost any scenario. And the great example he talks about, and the one that's so valuable, I think, to put yourself in that shoes of, is the APGAR test, which is one we've all seen. It's when a baby is born, the nurses or the pediatrician will run through a series of tests to see whether the baby's okay. And from a medical point of view, the APGAR test is pretty awful. It's actually a really bad diagnostic test. But it turns out that it's one of the best tests you can do in a delivery suite because it's a simple checklist and it requires you to look at the baby. In other words, the test is not good in and of itself. What makes it good is that you have to ignore all the noise, and delivery rooms are noisy rooms, and focus entirely on what is happening to the child rather than what's going on around you. And I think from that point of view, basic checklists, and we've got a pretty detailed one at Teaminvest and we can run through that, but really basic checklists of asking, is the company still the company I thought it was? What's really happening to its earnings, its debt, its sales, its moats, its risks? Those are in the end far, far better predictors of your future long-term performance than anything to do with the share price. And separating that noise of share price and what you read in the press from those fundamental questions is both the secret sauce to good long-term value investing and the hardest thing to do, because as you say, we're human and we're driven by emotion.
So when you buy a company, this is another way to look at it, should you already have a checklist of the conditions that would eventually make you sell?
Oh, absolutely. Look, it's easy to say, it's hard to do, right? But we talk about it as keeping a stock book, that idea of writing down when you make a purchase, what are the reasons you made the purchase? What is your investment thesis? And then consider that against what you see happening regularly. I mean, what regularly, I don't mean daily, but every few months, pull up what you've seen about the company and ask, is my investment thesis still intact? Because if your investment thesis is still intact, regardless of what's happened to the share price, you should be happy holding on to the business pretty much. Whereas if the investment thesis isn't intact, then regardless of what's happened to the share price, you probably don't want to be in it. Now, where it gets difficult is where your investment thesis and the share price move against each other. So, we talked about CSL last month, but that might be one where you say my investment thesis is intact, but the share price has fallen. And then you have to ask the question, who's right? My thesis or the share price? And that's a question of how much you believe in the work you've done to build up your investment thesis. On the other hand, the other really hard one, and probably more of the focus of today's session, is what happens when my investment thesis is broken. Something has happened that means my original investment thesis isn't true, but the share price is still rising.
Yeah.
Can I at that point confidently sell, or should I confidently sell, regardless of what Mr. Market is saying? Or do you hold on in the hope of a bigger gain? Now, we as long-term value investors, we'd say get out of Dodge now, put that money to work somewhere else where you have more confidence in the investment thesis. But again, that's hard to do. If a share price has just doubled and looks like it's still rising and you think it's a dog now, it's hard to go against the grain and sell it.
Mm-hmm. So expected returns obviously factor into your decisions. But I think it's getting back to my point about CSL. Can a great business simply become too expensive to continue holding?
Oh, absolutely. I mean, we've talked about this in other episodes, right? But if you think about it, the return you expect to get in the future is the function of two things. Number one, how does the company, the underlying asset, perform? Whether it's a piece of property, a commercial building, a bond, a share. So if you buy an asset that's growing, that's got a good fundamental basis for why it may be worth more in the future. But your return, not the return of the company, but your personal return, is predicated on a second element, which is the price you've paid. Now, because we are in a market that can trade frequently, it's not just the price you pay on the way in, it's the price you get on exit. And so let's take a really simple example because it's easy to demonstrate. If I offered you $50 for a $100 note, no one in their right mind would take it, right? But if I came to you and said, Nadine, for whatever reason I need cash, why don't I give you $150 in bank transfer for the $100 note in your wallet? You would be a fool not to take it. Now, Mr. Market throws up those opportunities in both directions with great regularity. For some weird quirk of human nature, Mr. Market will often offer you the opportunity to buy that $100 bill for $50 and very soon after buy it back for you for $150. And as a long-term value investor, that's what we love about the bipolar nature of the market. But it requires you to know what that value is that you're prepared to pay, and you have to know what that value is that you're prepared to sell. And to your point, you should know that in advance before it happens.
Okay. Now, I know that you've said that you want to focus heavily if anything has broken structurally, if you can call it that broken thesis for a business. So just to flesh it out, what are those key things that you look for? Again, do you have a checklist of some sort?
Yeah, we do. So there's 27 research proven quantitative factors that indicate, we've talked about this before, that the business may be a potential dog. So rule number one from our point of view is any one of those 27 filters ceasing to be green. In other words, things like the business has now got too much debt, or the stability has fallen apart, or the earnings per share are shrinking. Things like that, the obvious business elements. The second one to ask is, has anything happened to the moats, the future earning power of the business based on its competitive advantages and ability to extract margin? And we've talked about before, you can see that in the margins, you can see that by competitive behavior. And then thirdly, to ask, has something happened to the risks of the business? Now, the risks of the business are both the business itself, has something happened to trigger more risk, but also the humans involved with the business, particularly if there's key people risk involved. Once you know that one of those is breached, you're better getting off now than holding on hoping for a better price, because your opportunity cost of continuing to hold far outweighs what you could get if you just moved the money into something better. The only element we haven't spoken about, though, so far in that immediate sell reason is price. And that was the one we were talking about before, which is if Mr. Market then offers you a price that's stupid for the asset. So you say, well, look, this asset isn't broken, but it's clearly not worth what someone's offering me. I'd rather have the cash than run the risk.
And I hate to keep coming back to CSL as an example, but I know I will get email questions in about this one. When CSL's valuation was sky high, when it was way above what you reckon it should have been, but the market was willing to pay, $300, did you trim your position to use that money and deploy that capital elsewhere?
Yeah, in my personal capacity, I was fully out. In our funds, we were mostly out at around that price of, $300 to $350 a share. We bought back in, as we've spoken about before, and as it turns out, we probably paid more than we could have. The market went on sale more than we expected. So, it's like buying a pair of shoes and then seeing them go on a bigger discount the next day. It hurts a little. But yeah, absolutely. I mean, once the PE ratio, the market sentiment had got so high, and I'm thinking here in 2020, 2021, 22, 23, when it was high 40s, early 50s, a long-term value investor with a reasonable degree of being able to step back and separate the emotion from that, had to have a view that this would have to be a 1 in 1,000-year event for it to continue to remain at a PE of that high. And when things are that low odds, I prefer to avoid them.
Yep.
And I think most of our members would have been in the same boat.
Yeah, it's just an interesting case in point at this particular point in time. And
And I think even better, if you want to look at a couple today, I mean, have a look at Pro Medicus and WiseTech over the last 12 years. I mean, from that point of view, and Technology One, two at least out of those three, I think, are wonderful businesses. And yet, from a market point of view, all three got to a market sentiment or a PE of well over 100, which was not sustainable long term. And it's no surprise that all three of them are down more than 50% in the following 12 months.
All right. Well, you have set us
It's
up
nothing like
nicely.
business. It's just the price got silly.
Yeah. All right. You set us up nicely, Andrew. We'll go head to head. Take a look at some of these stocks next.
Wherever you are in Australia or New Zealand, there are investors like you who are done going it alone. The best investors we know aren't just disciplined, they're connected. Teaminvest is an exclusive membership for long-term, self-directed investors who approach investing like business owners and compound their knowledge alongside 700 plus peers. Masterclasses held across 9 cities. Register your interest by clicking on the link in the caption.
Well, every investor, I think, remembers the stocks that they sold too early, but often the bigger mistake is refusing to sell at all. So in this segment, we'll look at some real examples of Teaminvest exits, companies that stopped meeting the process, and others that perhaps were worth holding through periods of market exuberance, to uncover it all, Andrew Coleman is joining us once again from Teaminvest. So before the break, you were mentioning WiseTech and Pro Medicus. So again, talk us through sort of why it would have been, a sell decision at that time.
Yeah, well, what I will say in the first case here is when we're talking about WiseTech and Pro Medicus, let's take Richard White out of the equation, because with the word WiseTech in there, that throws in a whole bunch of noises. And whilst it turns out afterwards that the noise in that company was probably negative and destructive, no one knew about that noise a year ago, right? So if we're going to look at when we actually did exit, we must ignore what ended up being the case. That was lucky that we were out. But in the case of both WiseTech and Pro Medicus, these were businesses who on the numbers look wonderful. High return on equity, very high growth rates, high degree of stability, little or no debt, very strong moats, very low risks at the time around their business model. But both of them ended up in triple-digit PEs. In other words, market sentiment had gone nuts on the upside. There were comments being made in the AFR of, these businesses could grow at this rate forever. Now, that's never the case. The world never works like that. And very simply, once the PE ratio gets so high, the growth rate that you have to sustain in order to achieve a meaningful return as an investor is almost impossible. So in both of those cases, we exited. Now, amusingly, what's happened since, of course, is for a short period after that, the share price continued to rise almost parabolically. And so people would have looked at our portfolio and said, you fools, you've missed out on this upside. And then, of course, it struck midnight and they were exposed from a share price point of view to be mice dressed up as horses and footmen. And as a result, the share price crashed. And anyone who had paid these very high PEs is now materially underwater. Now, in the case of WiseTech, you've now had after that a whole bunch of issues around partners' mentality, which mean there's probably no price at which I would like to get back in. Pro Medicus, on the other hand, is a wonderful business, and at the right PE, I'd love to own more of it. But they're two really good examples of being able to say, our investment thesis is these were good businesses with strong moats, fast growth rate, but the value or the price that the market was now offering had differentiated so far from value that we were far better off exiting and putting our money to work elsewhere.
Yep. Okay.
Which is exactly what we did.
So what about a couple of stocks that might have appeared to be good value at one time? I'm thinking corporate travel management. I mean, that's a sad story in and of itself. Flight Center comes to mind. I mean, what sort of process would you be have thought about those businesses in terms of exit strategies?
Yeah, well, we mentioned before what our checklist is, and really our checklist boils down to three things. Firstly, does it fail the quantitative filters? Is there a reason the business might be a dog from the numbers? Secondly, does it fail the wisdom of our crowd? Now, we've talked about before, but we've got 700 roughly Teaminvest members around the country giving us that feedback all the time on these companies. Is there something good or bad about the company? And so there's a very good data set there for us to rely on. And then thirdly, does it fail the question of has something broken with the past? So if you take corporate travel at Flight Centre, of course, these were wonderful businesses leading up to the pandemic. They had been growing, at least on their numbers. Turns out maybe corporate travel's numbers were fudged, but the numbers that had been in the market's view were really positive leading up to COVID. And then, of course, COVID hit, and the post-COVID recovery just didn't come through in the numbers. Both companies, corporate travel and Flight Centre, kept making announcements and still do about how they're going to be larger than they were pre-pandemic, but it just hasn't happened. And so at some point, as a value investor, as a considered, researched and rigorous investor, you've got to look at the evidence of the data compared to what the company is telling you and say, look, maybe it will recover, maybe it won't, but it hasn't yet. The statements are more bullish than reality, and there are better uses for my money elsewhere. And so in the case of corporate travel and Flight Centre, we exited, thankfully, before the scandal in corporate travel, not that we knew that was coming, but we exited because the data of the recovery just didn't match what management kept telling us. In other words, the recovery wasn't coming through. And so objectively, we had to say, no matter how much we like or dislike this business, it's not worth owning. There are better things to do.
Right. Is there another example of a company that you would have exited because it passed sort of that member filter, so to speak?
Yeah, I mean, A2 Milk is the one that I use as an example. So A2 Milk, of course, was growing really, really strongly up till COVID. The Daigao, the people coming in, buying milk off our shelves, shipping them back to China, had meant the company had really high return on equity and really fast growth rate. And in fact, for a really small company, A2 Milk ended up on such a high PE that it broke into the ASX 50, which is, an amazing achievement from the company's point of view, but also a little bit crazy when you think that a powdered milk company could be amongst the 50 largest companies in Australia. But that's a different story. But when we looked at it with our members, we kept coming up with this problem of saying, where are the moats? You know, the earnings are growing fast and that's wonderful. Management's clearly doing a good job. But what moat, what barrier to entry or competitive advantage does A2 Milk have over any other milk maker in the world? You know, there's thousands of them out there. Some of the big ones like Nestle and others are doing this. What is it that a tiny little Australian and New Zealand company in A2 Milk has that means we think it's going to dominate the world in the way these growth rates are projecting they will? And so from that point of view, when we ran 18 different sessions on A2 Milk. It ended up with a 97% at its last one, 97% fail rate from our members. On the basis, nothing wrong with the company at the time, just we couldn't see the moat. In terms of timing, we were very lucky because that very last session was in September of 2021. And of course, if you know what happened to A2 Milk, it promptly crashed a few months later from $20 a share down to sub 5. So from that point of view, our timing was luck, but the thesis was right. If there's no moat, at some point competitors will eat its lunch or the profits will evaporate. And that's what happened.
Yeah. Now, I know that you care a lot about the debt position of companies at Teaminvest. So is there a company that you would have exited because the debt pile continued to grow? Or, you know, would you never have been fooled into buying in the first place?
Well, hopefully, if the debt's always been there, we never fooled, right? Because we should have avoided it from the beginning. But a good example of one that had no debt and then suddenly had lots of debt, and that was a catalyst for us to exit, was Min Resources. So if you remember, Min Resources' story originally started as a mining services company doing crushing of iron. And, you know, it was a really stable, good business with good return on equity, a really entrepreneurial, wonderful, at that stage, CEO in Chris Ellison. And they didn't have empire building goals. You know, their goal was to do crushing for miners and make a good margin and have relatively low capex. And then over a period of time, Chris Ellison and the Min Resources group started to get more and more into wanting to buy more and more mines and operate mines. And so the entire capex profile of the business changed. It went from a low capital intensity business with really steady contracts to a highly commodity business, so now very highly variable, with a big debt burden. And that's dangerous. Number one, a big debt burden is always linked with the risk of material underperformance. You know, things can go wrong. Debt is a four-letter word, as Buffett puts it so nicely. And then secondly, you've got a high debt burden on a company who cannot control the price at which they want to sell their product, in this case being lithium and iron ore prices. And so, you know, we exited Min. It started to fail our filters in 2022. Now, amusingly, of course, at around that time, was somewhere between sort of 50 and $80 a share. It got up to close to 100. So for a while, we looked like we were fools. And then, of course, it fell all the way down to the low teens and has since sort of recovered in between. Now, from that point of view, as a long-term value investor, you've just got to make the decision that you think is the right decision based on the previous data and the academic research. And the academic research pointed to the fact that once the debt had got that high and it was a commodity type business, there was way too much risk around future return. So what do you do if you're considered researched and rigorous and you're being rational and honest with yourself? You sell it and you put the money to work elsewhere and accept that someone else may make a gain on it, but they're going to have a lot of difficulty sleeping at night, whereas your money can be earning a lot more for you with a much, much lower risk profile.
Yeah, because there's opportunity cost in and amongst all
Absolutely.
of that as well. So Teaminvest filters, member filters, whether or not the business has structurally changed, and that includes obviously debt. Well, Andrew, thank you for giving us some clear examples of when and why you exited those businesses. We might leave this head-to-head conversation here if you don't mind sticking around, because of course we have our viewer question. We'll get there next because you asked. Well, each week, if you're a regular viewer, and we hope you are, we answer a question that comes from an audience member. So you too can email in wealthy@ausbiz.com.au. This one goes to Damien, who says, I've watched your Emerging Wealth Winners interviews. Just by the way, you can find them online at ausbiz.com.au under series. Damien asks, though, Andrew, do all emerging companies need to have 10 years of data behind them to be investable for Teaminvest? So that, Andrew, kind of ties in nicely with this program as well, because We've talked about those filters, and I've worked with you all at Teaminvest for quite some time. And I do believe it is that sort of 10-year golden rule, or is there anything different when it comes to smaller emerging companies?
Yeah, so our hard cutoff is 6 years. With less than 6 years worth of data, we just won't spend any time looking at it. And the reason for that, by the way, is you could run the maths yourself, but really simply, Damien, if you had a coin toss that a company could go up or down, the odds of it being just 6 ups in a row with a 50-50 likelihood are such that in less than 6 years, it's more statistically likely that it's a fluke of the coin toss than anything about the business. So it's really only once you go beyond about 6 years of data that you can say, my research says it's the business, something about a motor or a risk that's driving this outcome, not pure luck. So from that point of view, 6 years is our absolutely hard cutoff. On the other side of the equation, we talk about wanting 10 years of data because statistically the difference between 6 and 10 takes it from it's probably not luck into it's virtually certainly not luck. So from that point of view, we will start to look at emerging companies at the 6-year mark, but we'll really only be interested in investing a material amount of our wealth at the 10-year point. So, maybe you put your toe in the water at the year 6 or year 7 because things are looking good and, you want to keep an eye on it. But if you're talking about making it a meaningful part of your portfolio, our recommendation is always to have a minimum of 10 years of data to get around that statistical risk that what you're seeing is a fluke, either a point in the cycle, the economic cycle being on an upswing, so it looks better than really it is when the markets turn, or a fluke around just simply you can get 10 heads in a row, hard to do, 6 heads in a row, relatively easy to do, 3 heads in a row is incredibly common if you think of it as a coin toss.
Yeah, interesting. All right, Andrew, thank you for answering that question. Damien, thank you for sending it in. Andrew, we'll see you in the studio next week, perhaps. Really appreciate your time today and your insights as always.
Look forward to seeing you in person.
And thank you for watching Wealthy and Wise. Don't forget you can get those questions to Andrew and the team at Teaminvest, wealthy@ausbiz.com.au. Thanks for watching. We'll see you next week.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.